you think that is the case? That should actually, that's a risk that the exporters bear. So you're right, they should earn a slightly higher margin to take that risk. But, and that's a part of the reason, but it's not the major reason.
It is competition.
Yeah, so you said exactly what I had in mind, but the word I would give to it is location savings. A company in US which can do the activity in the US for 100 rupees and can outsource it to India for 20, the Indian guy also knows that. He will extract a slightly higher value from the US guy, then he will be able to extract from his Indian client. Because the Indian client says, "Main bhi kar sakta hu these rupees mein. What are you going to do over and above what I can do?" But the US guy can't say that. This is location savings. So till there is perfect competition in this market, margins of exporters are going to be higher than margins of domestic companies, and you should apply the export filter to remove purely domestic companies. In fact, I would argue that if you don't apply this filter, then you should actually suffer a location savings adjustment. Because your comparables are not even exporters. Their margins are based on the local market competition, which is not the market you're operating in. But there are other issues of filters, employee cost filter, R&D filter, advertising filter, goes into a certain level of detail, but there are subjective viewpoints on that which get debated.
Do you recommend turnover filter also for service companies?
Okay, let's go to that. Can you go to slide 12? So there was a special bench that was set up to actually adjudicate on the issues sir just raised, whether turnover filter should be applied or not. I had actually made a representation to the president of the tribunal that the questions that were framed for the special bench reference were not complete, and we had filed that we had requested the tribunal that they should revise the questions, which they didn't have to because the special bench was withdrawn. The taxpayer then withdrew the case from the special bench, and the special bench never got an opportunity to adjudicate on this issue. Frankly, if you ask me for my personal view, before giving my personal view, the way the tribunals have said is that there are enough tribunals which have said that in the service industry turnover is not relevant. I don't agree with that. I think it is relevant. Interestingly, in the service industry, higher the turnover, higher is your margin. But any particular reason? I mean, which is actually opposite of what it is in the manufacturing industry. Because in the service industry, the number of employees that you add, your bench cost reduces because your ability to provide a multidisciplinary service increases. Your ability to retrain people improves. Your ability to attract better talent improves. Everybody wants to join an Infosys. Everybody wants to join a TCS. So their ability to attract better talent improves. Your brand name is a lot. A lot of times you get excluded from a lot of bids because you're not a $1 billion company. So you get those really large contracts, multi-year contracts with a fixed fee component, share of savings component, and margins of high turnover comparables are actually higher than low turnover comparables. So in my personal view, a turnover filter ought to be applied. Way I look at it is apply at the lower end and the higher end the same one. I mean, people do all sorts of things. They will start from 1 crore and at the lower end, and on the higher end they'll apply 10 times of the taxpayer's turnover. I think you can do both ways the 10 times thing. And there are divergent tribunal rulings on that, and we were actually hoping that this special bench that was being set up would adjudicate on the right principles, and we made a representation that the question they had formed would not allow them to conclude on the right principles, but the special bench never went ahead. But I would apply a turnover filter. I would do an industry analysis, and that's the purpose of an industry analysis. That in a particular industry, what is the feature of companies having a particular band of turnover? So NASSCOM categorizes IT/ITES companies as tier 1, tier 2, tier 3. There is a reason for that. The challenges faced by tier 1 are similar but different from the challenges faced by tier 2 companies. And the challenges faced by tier 3 companies are very different. Some of these tier 3 companies are in rural areas where getting access to English speaking talent is difficult. So they actually have to do low end work. And their margins are lower because of low end work. So they are playing the volume game. But the high tier 1 companies are able to invest in brand development, product development, skill development, which gives them higher value work. So their margins are higher. So find out your industry structure and identify what is the right band in which your comparable taxpayer falls, and that's the scientific way to apply the turnover filter. But I personally believe it ought to be applied. But slide 12 gives you a sort of a synopsis of where the tribunals are at this stage, and it's not a consistent view, unfortunately. The last thing I want to speak about in the safe harbor, sorry. Yeah, so we covered turnover filter. The last thing I want to speak about is safe harbor rules. I think this has a huge potential in India if done in the right way, and done not just keeping technical criteria or very strong or strict technical filters, but done with a pragmatic mindset. Look at what they were trying to achieve. So they said that everybody knows what safe harbors are, right? Okay, just what the safe harbor is basically a settlement. Okay, you do cost plus 20, you do this kind of service, no TP assessment for you, no economic analysis required. We have done an economic analysis over what you should be earning typically. You just do a functional analysis and file a simple return. We will check your functional analysis and the matter is over. No, I don't think the safe harbor application even requires fees to be paid, and you get the outcome in 6 months of filing. Conceptually, this is a very powerful idea. The reason it is not taken up, and I'll come to those reasons after giving the group a slightly broader framework of what the safe harbor rules in India are. India is one of the first countries which has tried to implement safe harbor in such a detailed way. Most countries apply safe harbor to very small categories of services. India is, in the context of IT/ITES, the 4 categories they have created is software development, and the safe harbor rules have a fairly detailed definition of that. ITES, KPO, and contract R&D software. And the margins travel from 20 to 30. 22% for IT, depending upon the turnover, 25% for KPO, and 30% for contract R&D, which actually for any size of the company, you can go for a KPO safe harbor or a R&D safe harbor. Now, we spoke about the problems with the law, right? That the law is not perfect as far as doing comparability analysis for IT and these companies is concerned. Look at the problems TPOs are having in applying the subjective rules. Tribunals are inundated with 600 rulings. They will keep on growing. We'll reach a 3-4-digit number very soon. We'll all get intellectually stimulated and educated, but it's definitely not the right thing for the economy. So safe harbor is a very powerful idea which needs to get implemented in the right way. It's a superb start, and I think it's fairly simple as well. The only thing they need to get right is the number, and they're already looking at it because they received a handful of applications when it was put in place for financial year 12-13, which is the first year to which safe harbors are applied. They received a handful of applications because the number is slightly too high. I think what the government probably needs to do, and this is where it needs to travel beyond tax law and to policy, is it needs to create a mindset that, I was discussing with my friend here that he's got a 30 crore ITS company. They're asking essentially for 20% margin. Let's say they gave him 15%. The government's cost of doing the transfer pricing audit and taking him all the way to the tribunal to bring in that 5 crore adjustment is much higher than the revenue they are losing on that 5% difference. Make it a business win-win deal. And I think we are traveling in the right direction. I mean, having safe harbors was a big change. Now we need to take it to its logical conclusion and do a business kind of analysis of the technical rules. Reduce the categories. I mean, what is software development and IT? Yes, appreciate. KPO is so subjective. If you want, 20%, 25%, what's the big deal? Just push KPO into ITS. How many KPOs are we talking about? What is the revenue loss that you're talking about? But what you're going to do is that when you have this category, the TPO is also going to look for a KPO in a 30 crore company. Even in Safe Harbor, when I filed for Safe Harbor for ITS, the TPO says, no, you have 60 people, then 20 people are doing KPO, 40 people are doing ITS. Why? Because those 20 people are MBAs from some tier 1, tier 2 institute, the 40 people are graduates. I mean, we're not going to see an end to this discussion. I mean, we can all get intellectually stimulated and argue, but this is not the right way to do it. So Safe Harbor is a superb thing they're trying to do, and it needs to be taken to its logical conclusion, and I hope it sees, because I don't think anybody benefits from the kind of litigation we are seeing in ITS. So that's really I want to just glance through this to ensure that I've covered the most important things I wanted to cover.
As far as Safe Harbor is concerned, for ITS, one of the major conditions is that all significant functions should be performed by the AE.
Right.
Practically, do you think it is in how much percentage of the cases in India it is possible? Because everything is actually practically done by the Indian company.
It should not be a captive, no? You should bring all the profits to India.
So, significant functions are performed in India only.
So that's what I'm saying, then all the profits should be in India.
No, but then Safe Harbor condition, which they say 20%, for that it will not be eligible only.
It should not be eligible, na?
It will not be eligible.
Yeah, that's the right thing. What is the issue there?
No, but practically all KPO or BPOs are doing that only. Work is done in India, marketing is done abroad. So, 90% will be going out. They will not be eligible.
I think that's a very broad generalization. That's not my experience. My experience is, and maybe there are different categories. So the issue, did everyone understand the question he's raising? So his practical concern is that most of the captive companies, in his personal experience, are actually entrepreneurs.
Not entrepreneurs, but yeah, business is done in India. Deliverables are done from India.
Which is okay.
Yeah.
Which is okay, but what you have in mind is maybe an Indian has set up a captive ITS company and is running everything, and he set up a Dubai company which does the billing. All the profits are parked in Dubai and India is being paid cost. That's a wrong model anyway. You're never going to be able to support it if people get into the details. So there should be no argument on markups here. The argument shouldn't be whether it's a captive or not. But there are enough number of mid-sized ITS. I mean, look at it this way. I've had clients from Europe who want to set up captives, but they can't afford to set up 10,000 seaters or even 5,000 seaters. They want to set up a 300 seater. Their turnover will be what? 50-60 crores. India will be a proper captive, cost plus, doing back office functions because the headquarters is in Spain. They say that to set up a 300 seater in India with all these tax issues is just not worth it. India's got superb talent, which is why Europe has not come to India as yet. IT&S industry, the captives, most captives are US captives, which are large. But it will boom further if all the Europeans come with setting 300, 400, 500, and they will really benefit from something like this. No TP challenges, do business, take advantage of India's talent, and have certainty on transfer. And there are enough number of those cases. I'm saying from my personal experience. So I just want to travel this slide deck to see if I've covered everything. We spoke about the key issues and challenges. Pay attention to permanent establishments. We spoke about 3 big issues in comparability, turnover filter, thanks for raising that, high profit making comparables, and the BPO versus KPO. I gave you a small glance of what are the challenges in the law itself which are creating these disputes and how they will all travel to the tribunal and there's no respite before that. We spoke about location savings, which is a very important issue that we should keep in mind. It's an emerging issue and should probably be addressed in your filters and in your industry analysis. These are some peculiar issues, but in the interest of time, let me skip this. And this is the slide where he was coming from, that what is a captive company? To your right hand side, a captive company. Can I do that in the end? In the interest of time, I'll be happy to do that. So this slide provides you a perspective, and thanks for raising that question, because this slide tells you what is a captive BPO in terms of its functions. All the significant people functions are outside India, all the intangibles are provided by the principal, all key strategic decisions are taken outside India. India merely follows instructions, does the delivery, gets supervised and guided. If those are not your facts, you're not a captive actually. You should have a different transfer pricing model. We'll speak about PE in the end. We spoke about the most important decision of recent time, turnover filter, safe harbor, and I shared with you my passionate perspective on how we'll solve these problems using safe harbor. So these are really the lessons I would take from the experiences I've had. That the root cause is in a very good functional analysis. Do your comparability analysis very objectively, apply the right filters, export filter if you have to. And in my experience, the best time, I've not found all TPOs to be that unreasonable. What I've found is that the taxpayer treats the whole comparability exercise mechanically, and the TPO also does mechanically. There needs to be some distance traveled by the taxpayer to educate through the process of representation. Why is he doing what is he doing? There are going to be some TPOs who will set the right precedents. There are some who will either because they just don't have the time or all that. But we've had captive BPOs where TP assessments have been concluded at 21%, which is not a bad number. So we've applied the right turnover filter in the right way. Because remember, with so much subjectivity, the TPOs actually have a latitude to understand what you're saying and apply the right outcomes. So that the battle in an IT is actually won at the assessment level. Because if you don't win an assessment, you're going to go travel all the way to the tribunal. That's how I would like to close the discussion on IT-ITS. Should we take questions on IT-ITS at the end? That's better. It'll give us time to do financial services in the next 45 minutes. Okay. We'll spend a slightly longer time on each of these slides in financial services because it's a little peculiar, and I would like to use this opportunity to, even if people have not had any experience, let's travel together on these slides. So look at slide 17. I've tried to use case studies on each of these business models. Slide 17 is a very typical business model where an Indian company wants to borrow foreign currency loans, and it is the client of the Indian branch of a foreign bank, which is what we call client origination, client relationship management. So the relationship with the client was developed by the Indian branch of the foreign bank, but he needs a foreign currency loan. So the Indian branch is going to refer this client to its Singapore parent or Singapore branch to actually give the loan. So the loan will be on the books of the Singapore branch. The credit risk will be taken by the Singapore branch. The foreign currency risk will be taken by the Singapore branch. The liquidity risk will be taken by the Singapore branch, and the loan will flow from there. Now, the Indian client will pay interest and will also pay arrears, fees and commissions at the time of taking the loan. The interest income should clearly belong to the Singapore branch. No dispute about that, right? The interest income is paid for the liquidity risk, the credit risk, the foreign exchange risk that the Singapore branch is taking. But there are certain fees that are paid separately by the Indian borrower, arrangers fees or fine, origination fee to the lender, which is the Singapore branch. And the dispute in transfer pricing is there is some that fee has been earned by the Singapore branch. There is some activity or function done by the Indian branch to earn that fee because it generated the customer, it originated the customer. How should the Indian branch get compensated for its functions? And we'll stick to business commercial logic and then we'll come to transfer pricing. So is everybody clear about the fact pattern on this sheet? Yeah?
You can get referral fees.
Referral fees, okay. So referral fees will be what? A percentage of the fees that they earn?
Our income earned by the Singapore.
So let's say they earn a 2% fee. 2% being the value of the loan. we should give a share of that 2% to the Indian branch for originating the client. That's one model.
Pay the whole of 2% and something on the interest.
Pay the whole of 2%.
Because the interest is the real income for the Singapore.
Okay, but the fee is actually paid for a couple of functions. It's also paid for the functions of doing because when you go for a loan, you go for a home loan and a bank charges you a fee, right? They charge you a fee for doing your credit risk assessment. They charge you a fee to decide whether you will fit within their parameters of granting a loan or not. They'll charge you a fee for documentation. Because they have to do a lot of documentation. They have to do a review of your financial statements, whether you're credible enough to get a loan. So that fees for not just origination, that fees for actual functions being done. You pay a home loan processing fee. It's not just because HDFC contacted you. That you won't pay anything for. You pay a fee because HDFC spent time reviewing your financial status. They did a credit check on you. They have to spend money doing a credit check. If property title has to be checked, they have to spend lawyers' fees on doing property title check. So it's not just. So I would agree with you that the entire 2% should come to India because that 2% is not being paid for just origination.
Indian branch should charge at least the same amount of money which they charge if the loan could have not been provided by the ABC Bank Singapore branch. If the third party borrower directly take loan from the ABC branch, then what charges they would charge for this orientation and like processing fees?
Fair point though, but you will reach the same answer that he reached because I will charge 2%. Because I do all the functions. I will do credit checks, I will do credibility, all the stuff that I said. You will reach the same answer. So I don't, but look at what the Indian branch is doing for this transaction. It is only.
Isn't it a separate international transaction of business support services or ancillary services? And you have to benchmark this depending on the best method that you can choose.
So that's a third alternative. But I'll just finish with responding to him. The level of functions that the Indian branch does for a local customer is significant. The functions they have done here is just referral. They've just referred, somebody came to them and said, "Meko foreign currency loan chahiye." They came to me because I have a relationship with him. And I said, "Okay, main nahi de sakta hu. You go to my Singapore branch, I'll refer you." And then the Singapore branch did everything else.
But here it is mentioned the loan monitoring also, administration, orientation and sales support, documentation, credit review support is more than the referral.
But it's support. They won't take, like for example, the credit review, decision making, the guidance on how you should do the credit review, what criteria you should use, is all provided by the Singapore branch. So I'm now hearing to what the madam said here, which is it's a business support services. Some of it is a business support service. And if I were to do credit review support for somebody, I'm not going to earn a portion of the 2%. I'll earn a fee, I'll earn a processing fee, or which is based on my cost of doing a credit review, which is what a CRISIL would charge for a credit review. So where should the answer lie? So there are two answers, nothing or 2%. Both of these answers are wrong, right?
Cost plus 10 to 15%.
Cost being the cost of doing this function. So there will be a team doing this. But normally, what happens? There is no dedicated team doing this. They are doing their normal jobs. And in relation to, so they are managing the relationship with the local client for various other things. And the client also comes and says, "Mujhe foreign currency loan chahiye." So identification of cost can be done based on certain estimates. I'm not saying it cannot be done. It is being done also in real life, but I'm just challenging where should the answer lie and what should the approach be.
Excuse me, it be possible that they must be paying certain specific amount each month to Indian branch for arranging the plans?
No, they may be paying whatever they're paying, but we have to test whether it's at arm's length, whether they're paying the right thing. So every group has a policy on this, that if you originate, I will give you this much. Some groups give a share of 2%. Some groups don't give a share of 2%, they give a certain cost plus on the actual functions undertaken in India and the costs associated with their functions. So they will have their group pricing policy. Our role would be to conclude whether that is fair and at arm's length or not, and how will we benchmark it.
First thing I would say here is this cannot be done free of cost, because then there is not an answer.
Clearly, I think everybody agrees free of cost is out of question.
Because firstly we are receiving it. So if you do not get that money in India, of course the TPOs are going to
challenge that completely. So now the question is, what is the right amount to be charged? So that amount, I think, would be depend on. It's difficult to get a cup here because getting that exact kind of a comparability is different.
Is it?
It's very difficult to get that from another bank. See, if you go to any other bank, you tell them.
No, but databases.
I'm not sure. Honestly, I've not really gone into that aspect to see if the databases do provide that information. But it would be difficult. If it's possible, of course, that's the most preferred method. And of course, you cannot use the RPM, CPM, or DSM is not involved. So it obviously boils down to the DNO.
Correct.
And then I guess
What about profit split?
profit split, I think, is more for intangibles. Right? This is not a case of intangibles.
Client relationship is an intangible.
This is more of like, okay, I'm here at the front office desk and I have a client today coming to me and saying I want funds. So I just refer him to the department. It's not really to do with my. He's not coming to me for. I mean, he's already my client or whatever. He wants something. I'm just referring him to the right department, and I'm helping my offshore, offshore entity to with the business support. So I think I would have. At least my best answer would be the TNM with the ancillary support or the business support. So just search.
Okay.
Cost plus percentage.
So how many people broadly agree with her? People are not raising hands because they're sleeping so much. But how many people broadly disagree with her? Still people won't raise hands.
But
Yes, yes, sir.
Singapore company charge. So Charlie got to Indian head branch, all the country. Their percentage should be the same. So with the guidelines they have a model for them. It is applicable.
So you're saying that they would be getting origination from different branches in different countries, and they would have a global policy to share a certain percentage of 2%, and that global policy, if it is followed in India consistently, then that becomes a good basis to argue. But just because you follow a global policy doesn't make it right. A limited point.
So I think cup method, if suppose in Indian bank.
So just okay. So that's a fair point. Just because it's the only comfort I would get from a global policy is that it has been reviewed, tested, validated in more countries using transparent principles, and so it should also fly in India, or it should also work in India. It's a very strong argument, but it cannot be the first argument. I'll make it my second argument.
I think cup method because we may compare the how much we are paying to our Indian subsidiary bank, and if I have appointed any suppose agent in India.
It's a good one. She's saying that you may not be present in certain countries.
Yes, we may appoint agent in different.
You may use financial intermediaries in other countries to originate customers, and you may be giving them some percentage, or you may be giving them a fixed fee. And it may not be in the same country; it may be in a different country. So what? It's a good internal car. Great. Next, but if you don't have that,
I don't have
They have to go to the external.
quotations, other method.
external cup is a good answer, but she's right that it's difficult to find but not impossible to find. So there are very niche financial databases which have data around these things. You will have to glean from that data, but to give you a response, it is possible but difficult to find, and those kind of approaches have been implemented in practice by looking at these databases and the kind of information they have on origination fees paid. So, for example, these databases capture all the charges paid by a borrower on a certain loan, and there is a category called origination fee, which is paid to a third party because the borrower had to, go through a financial intermediary to actually get a loan. And a lot of people use financial intermediaries to get a loan from a bank. For various reasons, the financial intermediaries have a good working relationship with the bank, they understand how the banks work, and so on and so forth. So there are external cups, not impossible, should be evaluated. It's a great answer.
Which are the databases?
Deal scan, loan connectors. So the last point I would make is that I would not again rule out profit split here, and I agree with the point that there is no strong intangible here, but customer relationship is an intangible. The OECD talks about a contribution analysis approach, which says that, have you guys had a session on profit split method? Okay, so you've heard about contribution analysis, right? So what does the contribution analysis say? You identify all the functions in the value chain which are generated